order. The first item on the agenda today is to approve the minutes of the July 13th, 2017 meeting.
Move it. Second.
Have a motion and a second. All in favor?
Aye.
All opposed? Motion carries. Item number 3 is a consent docket. We have one item. Have a motion and a second on item 3A. All in favor?
Aye.
All opposed? Motion carries. Item 4 is to ratify approvals. We can approve these subject to individual considerations. Have a motion and a second on item 4. All in favor?
Aye.
All opposed? Motion carries. Item 5 is to approve the claims docket.
Second.
Have a motion and a second on item 5. All in favor?
Aye.
All opposed? Motion carries. Item 6 is to approve the following applications for service retirement. We have 5 applications. Have a motion and a second on item 6. All in favor? All opposed? Motion carries. Item number 7 is to receive the report of death, authorize the payment of the $5,000 death benefit, and approve continuation of pension to the spouse. We have 2 cases. Have a motion and a second on item 7. All in favor? All opposed? Motion carries. Item 8 is to receive the report of death of employee while in active service, and approve the pension to the spouse.
Second.
We have a motion and a second on item 8. All in favor? All opposed? Motion carries. Item number 9 is to receive the report of death, authorize the payment of the $5,000 death benefit, and authorize the Secretary to make necessary changes to conform on the following. We have 5 cases. A motion and a second on item 9. All in favor? All opposed? Motion carries. Item 10 is to approve the request of the following to terminate vested rights and commence drawing retirement benefits. I have a motion and a second on item 10. All in favor? Aye. All opposed? Motion carries. Item 11 is to ratify approval request of the following to terminate vested rights and receive a lump sum distribution of his or her employee contribution account. I have a motion and a second on item 11. All in favor? All opposed? Motion carries. Item 12 is items for individual consideration. Item A is a resolution approving the level determination reporting service agreement with Northern Trust Company and ratifying the chairman's and secretary's actions in executing the level determination reporting service agreement prior to formal approval of the board. Anybody have any questions? I'll entertain. I have a motion and a second on item 12A. All in favor? Aye. All opposed? Motion carries. Item 12B will be the item that was added late. It's a resolution finding that the Oklahoma City Employee Retirement System finds no apparent conflict of interest adverse to the interest of the system and the Municipal Counselor's Office retaining the services of Gabriel Roeder Smith and Company and Louise Gates to provide testimony and professional actuarial services in the litigation styled Wade versus the City of Oklahoma City and Douglas Cupper, case CJ-2016-3270, Oklahoma County, Oklahoma.
Second.
I have a motion and a second. Any questions? All in favor?
Aye.
All opposed? Motion carries. Okay. Item number 13 is the investment consultant report. Patty? Yay, Patty.
Good morning.
Good morning.
Everybody should have 2 reports, one with the brown cover, which is the quarterly report, and then we have the monthly July ASAP that we've passed out as well. So I'll begin by just going over the June 30th quarterly report, which has a lot more detailed statistics than the monthly report that we usually go through. Just to start off, markets continue to be very stable and moving upward. Volatility is at the lowest level that we've seen in a very long time. An interesting statistic that I just read earlier this week was that in the past 20 years, there have only been 26 days of single-digit volatility, and 18 of those days have been in 2017. So just as a reminder, the VIX index measures volatility, and volatility is how much, the price of the market may move up or down. And we haven't seen a whole lot of movement in either direction, either up or down. It just continues to be very, very, very stable. Despite some of the talks and discussions surrounding, Korea, I was surprised earlier this week and last week that the markets didn't move at all. But the markets have been doing very, very well. And a lot of that's been to strong corporate earnings and revenues. S&P is at an all-time high, and unemployment rate continues to be at a very low level, 4.3%, which is at the lowest level since 2001. If you look at the returns for the overall market as of June 30th, which are on page 11, you can see the S&P 500 is up 9.3% year-to-date. The Russell 2000 up 5%. International stocks, which is represented by the MSCI EAFE, which represents international developed markets, up 14.2%, and emerging markets is the best performing asset class, up 18.6%. Emerging markets are those less developed countries such as China, Brazil, and India. While emerging markets are one of the top performers this year, historically they have struggled. Emerging markets tends to be a volatile asset class, so it's important to have the right size or the right amount of money allocated to that asset class. So you all have a 5% target to emerging markets. You're participating in some of that, in some of those gains, but also it's important to remember that you just have a 5% allocation to that market because it is a very volatile asset class. And when you look out over longer term, you see 3 years up 1.4%. So we've seen a huge reversal in emerging markets really beginning in January of this year, and the results have continued to be strong throughout the month of July. Also, when you look at the one-year returns, we've seen a reversal. International stocks are now outperforming U.S.-oriented markets. So, Europe has had a very strong run, also combined with emerging markets, and it's now outperforming U.S. markets, which is a reversal for the prior 5 years. When you look at the equity markets versus, a growth versus a value-oriented portfolio, growth is now outperforming value. You see the Russell 1000 Growth Index up 14% on page 12 versus the Russell 1000 Value at 4.6. This is also a reversal from 2016. In 2016, value outperformed growth, and in 2017, growth is outperforming value. Again, it illustrates the importance to having a balanced portfolio, so you have exposure to both value-oriented stocks and growth-oriented stocks. We don't tend to have a bias towards one particular sector of the market over the other, because you never know which sector will be doing well and when. So we want to have an allocation to both sectors and strategies. On page 13, you have the sector returns for the overall market for the S&P 500. Technology has been the best performing sector in the U.S. and globally, while energy has been the worst performing sector, down 13.8% as oil prices remain low. On page 14, you have the returns for the international markets. One interesting statistic on this page, I think, is that all the way over to the left under the year-to-date column, you have the MSCI EAFE, which is at 4.2% year-to-date, and then you have the MSCI EAFE local currency, up 7.9%. So the dollar has weakened this year, which has helped returns abroad. So it's making U.S. investors' returns more attractive. You see that 4.2% return, that's in U.S. dollars, versus local currency at 7.9. So you're getting almost about 500 basis points purely from currency alone. Again, you can see the year-to-date results for the emerging market up 18.6, very strong over the past 12 months too, up almost a little bit more than 24%. This has really been led by a rebound in China and Brazil. Both have been very strong performers so far this year. Flipping forward to page 19, this provides an overview of the fixed income markets and some of the returns for the different sectors of the fixed income market. This chart at the very top left, you'll see the different sectors of the bond market and the returns for 3 months, year-to-date, and the one-year period. You can see U.S. corporate high-yield bonds have been the best-performing sector of the bond market at 4.9%, followed by U.S. investment-grade corporate bonds up 3.8%. As interest rates rise, you can begin to see negative returns in the bond market. And so we think that it's very important to have an allocation to bond managers who have a lot of flexibility to invest in the different bond sectors of the market. And so you guys have an allocation to WAMCO and Brandywine, who both do different things. Brandywine has an allocation to emerging market debt, which has been very beneficial this year. A lot of that return has come from the currency, as well as just exposure to the emerging markets. And then WAMCO has exposure to both high yield and corporate bonds. So those two strategies are complementing your core bond manager, which is State Street, which has had mediocre returns and positive, but not as good as Brandywine or WAMCO. And so those three strategies together work well, and your fixed income portfolio has performed very well so far year to date. If you flip forward behind tab 2, we have the total portfolio dollar reconciliation chart on page 22. And this provides you a snapshot of how the portfolio is done on a dollar terms basis. So instead, we're looking at a lot of percentages. Most of the time, these are all dollars. And so at the beginning of the quarter, the portfolio was valued at $678 million. 5.1 million came out, and the return on investment was $20.2 million in the quarter, ending the quarter with a $694 million market value. Just to put that in a little bit of perspective, too, at the beginning of the year, the portfolio was valued at $660 million. So you've had almost a $50 million growth so far in 2017 from the return on your assets. So very, very strong results. On page 23, these are the performance objectives. And this is what's listed in your investment policy statement. It says what we're trying to achieve on a total portfolio level. So not only is return important, but other things such as risk. How much risk are you taking on in the portfolio? How much sensitivity do you have to the markets? How is your portfolio doing in up markets? How is your portfolio doing in down markets? And so we outline these here on page 23. And, we have yes or no, whether you're meeting or not meeting the objectives. And when you look at the 5-year column, you're meeting all these objectives. And so you say the total portfolio should outperform the actuarial rate of return, which is 7.4%, over a 5 and 10-year period. And over 5 years, you've got almost a 9.3% return. In 10 years, 5.5% return. So you're meeting the objective over 5 years, but not meeting it over 10 years. Once 2008 and the first quarter of 2009 rolls off, those returns, will start to be much stronger. If you look at just the 8-year return, so if you look at the return for April 1st, 2009 through June 30th, 2017, so that's taking out all of 2008 and that first quarter of 2009, the portfolio is up 11%. So definitely meeting that 7.4% actuarial return objective. And like I said, as those bad quarters roll off, we'll start to see an improvement there. We also have a measurement of a policy index. So that's saying, how's the portfolio doing to the broad markets? If you were invested passively just in the large cap stocks, small cap stocks, international equities, over 5 years you could get a return of about 8.6%. Your portfolio is generating 9.3%. And over 10 years, portfolio is about 5.6% versus 5.5%. So right in line there. And very good over the 5-year period. The third bullet point down is you want to have less volatility than the overall market. So that's a measurement of the standard deviation. And you can see over both 5 and 10 years, you have a lower number. So you want that number to be less than the benchmark, and you're achieving that in both time periods. And then
Can I ask just one question?
Mm-hmm.
On the $50 million return, or the gain that you said that we've had,
Yep.
that's not contributions. That doesn't include contributions. That's just market.
That's just investment gains
Okay.
alone.
Okay.
And it doesn't, right. So if you look at the net additions for the calendar year for 2017, which would include contributions plus withdrawals and benefit payments, it's $20 million. So if you did the math, you started at $660 million. $20 million came out, you had $52 million in return, and you're at $694 million at the end of the year. And then lastly, we want to look at the portfolio. How is it doing in negative market environments? It's always important to remember that it's just as important to protect in a negative or a downturning market as it is to participate in a positive market environment. If you can protect some in a negative market, although we haven't seen too many lately, you can protect the overall value or the dollars in the portfolio. And so we look at that. 100 says that if the portfolio were down 10% over 5 years, your portfolio would be down less than that at 9.2%. If you look at that over a longer period of 10 years, if the market was down 10%, your portfolio would be down around 9.1%. So you're providing that downside protection, which is always good and we want to see. Page 24 provides the overall current allocations versus the target allocations. So you have a 60% target to equities, 25% to fixed income, and 15% to real assets. Everything's pretty much in line. Have a slight overweight to equities. But there's a plus or minus range around that, so nothing alarming, just a little bit overweight to equities, and a slight underweight to real assets. On page 25, shows you the total portfolio's exposure to emerging markets. So as of June 30th, 2017, there's around 10% exposure to emerging markets. And that's primarily coming from Wells Capital and Wasatch, which are your two dedicated emerging market managers. And then also Brandywine's Global Opportunistic Fixed Income Portfolio, which has about a 40% allocation to emerging market debt. Page 26, just want to focus on two of these charts on the risk return chart on the top left and then the chart in the middle. This provides a picture of some of the stuff we just talked about in the risk return. So your portfolio is represented by that blue square. And you always want that to be in the upper left-hand quadrant. And that's saying that you're achieving a higher return while taking on less risk in the overall portfolio. And then the numbers of the statistics in the middle there shows you the up and down capture over a 5-year period. So you always want the up capture to be greater than 100 and the down capture to be less than 100. And you can see both the up capture and the down capture are doing just that. And then the beta, which represents the sensitivity to the overall markets, you want that to be less than 1. And so it's at 0.95. Flipping to page 28 shows you the results of the portfolio and also ranks them in our two peer group universes. So here you can see the long-term results. Portfolio's up about 11.4% over the trailing 1-year period, just shy of 5% over 3 years, 8.6 over 5 years, 5.5 over 10 years, and since January of 2002, up about 6.5%. When you look at that versus other public funds, that's that purple bar there, that represents the median portfolio in a public fund defined benefit universe. And you can see that your portfolio is doing better than other public funds over the 1, 3, 5, and 10-year periods. And those numbers down below, that second number behind the slash, represents your actual peer group ranking. So over the 1-year period, you rank in the 49th percentile among other public funds in the defined benefit universe. Over 3 years, 47%, and over 5 years in the top third at 33, and 10 years in the 47th percentile. Yes, so one is the best, 100 would be the worst. And so you want that number to be less than 50, generally. It'll vary over time, but your rankings in the public fund universe are very, very good. And then the other universe that we show there, which is the gold bar, is other portfolios that have a similar equity allocation. It gets a little tricky, though, because of the equity allocation ranges from 55 to 70%. So you guys have a target allocation to equities of 60%. So obviously, any portfolio that has a higher allocation to equities, closer to that 70% range, is going to do better over the more recent 5-year period because equity markets have done so well. But even within that, you guys over 3 and 5 years still in the top half, over 3 years in the 47th percentile, 5 years in the 39th percentile, and 10 years in the 40th percentile. So the number before the slash, that's the ranking in a universe with other portfolios of similar equity allocation. So that equity allocation can range anywhere from 55 to 70%. So you guys have a target allocation of 60% to equities, so it's kind of in the middle. So a portfolio that has an allocation, a closer allocation to 70% equities, obviously is going to have done much better over the last 5 years than a portfolio with an allocation of 55%. So it's just another measure to say how are we doing versus others, and it's the ranking gets broken down. The peer group, the range is a little bit more broad, whereas in the public fund universe, it's other public funds with no there's no emphasis placed on how the portfolio is allocated. So there's two different rankings. Both are very well, and it gives you a different perspective on how the portfolio is doing in two different universes. On page 30 and 31, this provides an overview of how the market or how the portfolio is done over different time periods. Generally, I would just say your portfolio has done very, very well over the most recent period. Year to date, you're up almost 7.8% on a net fee basis, up 8.1% gross of fees. Outperforming the policy index, which is at 6.7%, outperforming the median peer that we just talked about, both the median peer for defined benefit as well as similar equity allocation. And when you look at your managers, obviously emerging markets, because it's the best performing asset class, has done the best. So you see Wasatch and Wells Fargo on page 31, both up 20+% year to date. International equity, which is a combination of your Harding Loevner and Lazard, is your second best performing asset class in the portfolio, up 16%. Harding Loevner's up 17.8%. Lazard's up almost 15%. So Lazard previously had been lagging a bit in 2016, and we've really seen a change in their performance over the course of 2016. Had a very strong quarter in the second quarter, and also had very good performance in the first quarter. But both managers, Harding Loevner and Lazard, are doing two different things. Harding Loevner's focused more on the growth-oriented side of the market, and Lazard's focused more on the value side. So they're complementing each other. When you take those two portfolios and you roll them up, you get a very strong return of 16% versus the EAFE at 14.2%. Domestically, looking at the large cap portfolio, are up around 10.5%. Times Square and Unearned Partners, which represent your small to mid cap managers, up 10.3%. So very, very strong results on the equity portfolio. And if you flip the page to 32, you'll see similar things with your fixed income managers. The overall fixed income portfolio is up just a little bit more than 5% year to date versus the Barclays Ag, which is up 2.3%. So almost double that, or a little bit more than double that for your fixed income portfolio, which is huge because in the fixed income world, if you can eke out 30, 40, 50 basis points, that's an achievement. And so, Brandywine has really added to portfolio results there, up 10% year to date. And again, a lot of that can be attributed to their emerging market debt exposure, as well as the currency play there. But again, it's important to remember what percent it represents of the overall portfolio. So you can see here, as of June 30th, it represented just shy of 7%. So it can be a little bit more volatile strategy, whereas the State Street Core Bond, is kind of more your steady Eddie, which is up about 2.3%. Western Asset Management is up about 4% year to date, and they have a flexibility to invest in both U.S. and non-U.S. markets, investment grade and non-investment grade securities. So a lot of flexibility given there to them to invest in the markets that they think are most attractive. And then the real assets portfolio up 1.7% year to date. Real estate has done very well over the last several years. I think if you look at long-term results, the Morgan Stanley Prime Property Fund up 13.4% over 3 years and just a little bit more than 14% over 5 years. Going forward, our expectations is that real estate will give you a return around 5, 6, 7%. So far this year, you're close to that 5% mark. So I think maybe end up maybe closer to 7%. But we've seen a lot of appreciation in the real estate markets over the past 5 years, and so some of the return for real estate comes from income, and the other part comes from appreciation. And as the prices have appreciated, it's eventually going to level off, and then the return will come more from the income component, or the rentals of, receiving the rents from the properties, which will bring that return down, closer to the 5 or 6% range. And commodities, down about 4.8%. Year-to-date, commodities were positive for the month of July, which we'll talk about in a second. But did anybody have any questions on the portfolio as of June 30th?
I think I'm still having a stumbling block with the ranking, how it's reported.
Yep.
So when it says 54 as the numerator and 36 is the denominator, can you just break that down? Does that mean the 54th percentile?
Yes.
Okay.
So it's ranking 54th percentile in that universe. So 1 would be the best, 100 would be the worst ranking, 50th is the median, so it'd be 54th percentile. So you want the number to be below 50. Is in the 36th percentile, the top third. Yes. Mm-hmm. Mm-hmm. Yep. Any other questions? Just real quickly, everybody should have this handout, gives an update on the portfolio as of July 31st. Portfolio is now, the market value of the overall portfolio is above $700 million. It's $706 million. With the asset allocation, everything's, in line with the targets. Whenever, Bob or needs money to pay benefits, that's primarily the tool that we'll use to rebalance the portfolio to its targets for benefit payments. Looking at the page 2, you can see the portfolio is up 1.8% for the month of July, bringing the year-to-date return closer to 10%. So markets continue to climb. Portfolio continues to do very well. Emerging markets, again, was the best performing asset class in the month of July. Non-U.S. equities outperformed U.S. equities, and currency was helpful in the month of July once again. So, just to summarize, no concerns regarding any of the managers in portfolio. I know next month, Jason wants to try to get the group together to do an education session to talk about the hedge fund portfolio, about ways that we could potentially have a more customized portfolio with some substantial fee savings there. So I know Renee is going to try to get the group together and work on a date that we can have an education session with you. But overall, the portfolio is doing very, very well. Your managers are doing well. Performance is very strong, and we're pleased with the overall results. Any questions?
Thanks, Patty. Okay. Item number 14 is comments from board, staff, and citizens. Hearing none, we are adjourned at 10:31. Thank you.